Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, January 14th, 2025 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host here for the next 30 minutes or so as we prepare for the market open. This morning, we did get one of those inflation reports out. It came in pretty tame. Market initially had a really positive reaction in futures. It's kind of waned a little bit since then, but still positive, at least last time I checked. We'll look at that in just a couple minutes. But the core PPI, now, of course, I like to follow the CPI. I think the CPI is much more important. I think that's the one that the Fed uses. And we really want to see what the inflation is at the consumer level as opposed to the producer level. Producer is important, but what they pass along to consumers, I think, is more important. And so we've got that one coming up tomorrow. But at least for a day, maybe some of the inflation worries will subside a little bit because the core PPI was expected to rise 0.2%, and it was flat. So it did come in well below expectations. Again, that should ease some of the inflationary concerns, but I was looking at the 10-year Treasury yield, and while we had an initial move to the downside in the yield, it has come roaring back, and now it's down only 1 basis point last time I looked. Again, we'll look at that in a couple minutes as well. So your guess is as good as mine. I mean, you know, in the short term, I'm not sure how the market's going to react to all of this. I would expect, though, obviously, that the bulls are much better off with positive inflation data than the other way around. And so at least, you know, the first step is in the books, and it was favoring the non-inflation folks out there, or the bulls in the market. And we did get an initial positive reaction, but we'll see how that carries out throughout the day. And then tomorrow we'll get step two. And again, I think that's the bigger step. I believe that we're looking for, I want to say 0.3%. I believe is the estimate. You have to double check me on that one, but I think it's 0.3 is the expected number. And I would imagine anything less than that, even that number would be okay with the market, but anything less than that certainly would be good. While on a monthly basis, I'm watching that 0.4 level because throughout history, when inflation has not been a problem on an annual basis, the monthly range is generally 0, flat, to about a rise of 0.4% or 0.4%. So I think anything above 0.4%, I believe, is a little bit outside the ordinary. I think the market would not react to anything like that very well. But again, expectation 0.3. So we'll see what happens tomorrow morning. But at least for today, it is in the books. Inflation did come in below expectations at the core level. And I think also at the headline level as well. I think it may have been 0.3 expected, and it came in 0.2. But I'm not positive about that. Actually, we'll take a look at that, though, before we get started, because I do want to make sure that that's the case. So just bear with me for a second. And yeah, the headline number was supposed to be 0.3. Last month, it was 0.4. So for November, the headline PPI number was 0.4%. Consensus estimate for this month was 0.3, or for December, I should say. And the actual was 0.2. When we exclude food and energy, so we get to the core PPI number, in November, it was 0.2%. Consensus was 0.2, and it came in at 0. So we did come in below expectations. So again, the news there was pretty good. Looking at the futures, I'll just take a look at the ETFs that track the major indices. Right now, the diamonds are up 0.25%, so about $1.11 on the price. S&P 500 up about a little over 1/3%. So it's up a couple bucks, 583.46. The QQQ currently is up about 0.5%. So that's $2.46, taking that up over $508. And then the IWM, which has been the leader throughout the morning, is up about 0.75%. That's up $1.66, so it's at 218.91. We did get down to close to 214 yesterday. We're up pretty much at the opening bell. And so that getting back up now to almost 219 feels better. Certainly doesn't reverse the overall downtrend that we've been in, but it certainly feels better. And we'll see how things trade throughout the day. But as I mentioned, the 10-year Treasury yield, let me give you that, and then we'll get this thing going. 10-year Treasury yield right now is at 4.80%, which is flat. So no change in the yield right now on 10-year Treasury, which is kind of interesting, and tells me, well, it potentially tells me that maybe yields are going up because the economy remains resilient. We saw that big jobs report last week. It may have more to do about the economy than inflation. That's what all my other signals are telling me. So all of a sudden, the yield's hanging in there, even though we got a much better inflation report than what was expected. So anyhow, let's go ahead and take a look at the action from Monday, how we kicked off this week. It was great on the Dow. You can see the Dow Jones rising 359 points. That was close to 0.9% on Monday. S&P 500 up much less, up only less than 0.2%. NASDAQ was actually red. The NASDAQ 100 red. Small caps up about 0.5%. Mid caps up about 0.8%. And that VIX, which opened the day yesterday up over 21, finished at 1919. So that's good. If we get a decent start today, watch the VIX. But my guess is we'll see that VIX moving back down into the 18s, possibly 17s. And, if we get back down below that 16, 17 level, all of a sudden, that pretty much, well, it doesn't guarantee us anything, but it's telling us, signaling that this is not a bear market. Anytime we've gone into a bear market, the VIX has remained above 16, 17 range until the bear market ends. Well, if it ends before it ever really begins, then you don't have one. So that's certainly an indicator that I'll watch as well. I think sentiment always plays a big role in the market. I look at the equity only put call ratio. That's more retail oriented. I think when I'm looking at the VIX, I think more market maker oriented, because the VIX kind of tells us, based on the pricing of options, which is what market makers do, based on the pricing of near term S&P options, the VIX, when it goes up, is telling us that we should be expecting a lot more volatility. And anytime we expect volatility, that usually means downside action. And then when the VIX goes down to low levels, it's telling us the market really isn't expecting much of anything, which is generally very, very bullish for stocks. So right now we're kind of in the middle. We're elevated, but we're not in horrible territory. I thought yesterday's open, what happened from yesterday's open was very, very important, because we did have a VIX at 21. We had a lot of our major indices that were being tested at some very, very key levels, which I'll go over with you in just a moment. Moving on to the sectors, materials jumping yesterday 2.25%, energy up more than 2%. So I consider those two to be more neutral, just because the market can be going up, market can be going down. XLE, XLB, a lot of times just kind of beat or move to the beat of a different drummer, if you will. So materials and energy tend to just kind of do their own thing. It really doesn't give us signals about whether we're in a secular bull market, bear market, or anything else. Materials and energy many times will just trade on their own. But leadership, if you do look, we had 9 out of 11 sectors in positive territory. But beyond materials and energy, we had leadership from healthcare, real estate, industrials, financials, and then down here was consumer staples. And if you look at the three really aggressive groups, the three I like to follow, consumer discretionary, communication services, and technology, didn't really see a big recovery yesterday. And, given that we had a nice finish in the market, that's a bit concerning. It's also the primary reason why the NASDAQ couldn't get out of negative territory. Technology down 0.71% on the day. So it was much better than it was early in the session, but it still did not go positive. So if we do have a good day today, looks like we're going to get off to a reasonably decent start, assuming we hold up for the next 20 minutes or so. But if we do have a decent day today, I want to see if some of those aggressive areas start to do better on a relative basis. Check out the top of the leaderboard today. I think that's going to be important, not just for today, but as we go forward. I think there's a reason to be a little bit, for us to see a little bit of trepidation in some of those key indices, the really aggressive ones, because we still have the CPI report to go on Wednesday. If that comes in below expectations, I would really expect to see technology and some of these other areas move much better and much better on a relative basis, not just on an absolute basis. So anyhow, that's kind of a look at where things were yesterday. It was nice to see a reversal. It was nice to see the market finish up and finish on highs, and in many cases print some nice reversing candles, which I think is probably leading to some of the strength maybe we're going to see here at the open. But beyond that, these reversing candles are not designed to be long-term signals. They can start what could be a long-term advance or, intermediate term advance, but they don't necessarily, you don't need that to begin one. And even if you get one, that doesn't guarantee us we're going to have a much bigger advance. So, but it is a short-term reversal. And so we'll see what happens after the opening bell, see if we can tack on some more gains and trade higher than we did yesterday, higher highs, higher lows, higher close, that sort of thing, and then go into the Wednesday report and see what we get with inflation on Wednesday. I think that's pretty much the only way to approach it at this point. All right, 10-year Treasury yield. So I wanted to get an update here for you. And there we are. We're at 4.795. So we're down about 1 basis point. But if we look at the intraday today so far, you can see right after the announcement, because the bond market opens at 8:30. So right before the announcement, or right at the announcement of the lower PPI and lower core PPI, you can see it was a pretty big drop yesterday. We went down and actually took out the low from yesterday. We were down to 4.75 and a half. So that was down probably about 4 or 5 basis points to the downside. And yet we were reversed up, came back up close to the 48 or 4.80. And if we go through 4.80, I think that would signal a couple of things. Either the bond market, either traders in the bond market are still worried about that CPI report tomorrow, or maybe this is more about the economy than it is about inflation, which again would line up with many of the other signals I'm seeing in the market, which namely are hedges against inflation that really aren't performing that well. So we'll see how all of this plays out. But for now, the fact that we're still hovering up near 480 really starts to have me leaning more about this whole move being more about the economy than about inflation. But anyway, what we're hearing in the news, the media, the headlines, this is all about inflation. I'm just saying maybe it's not, based on the way we're looking at other markets and so forth. All right, S&P 500. So maybe I'll shorten this chart. Take a look at the last 6 months, and then kind of zero in over here. That was the hollow candle that we saw yesterday. So we had the gap down. We went down basically to gap support. So if we go up and check that inspector, the gap over here, and this was right before the election, we actually finished at 57.82.76, and then with the election results gapped up the next day. So that 57.82, 57.83 is our gap support. Well, yesterday we opened at 57.82. So we opened almost exactly on that gap support, and we saw buying throughout much of the day yesterday. So get rid of the inspector. Let's take a look at that 5-day, 10-minute. And you can see that basically the open was the low of the day. We went back around noon Eastern and we tested that, put it in a double bottom. I said in our daily market report to our members yesterday, that double bottom, when we came back down at noon, that's when I actually took a shot and I'll show you the IWM in a minute, but I took a shot on the IWM, switching out of the IWM and moving into the leveraged. Don't know whether or not that's going to pan out. I'll keep a stop, pretty much just below where I got in. But this is an area that I think we could see a significant rally off of. And again, I think a lot of that's going to come down to the CPI report tomorrow. I think, again, if we come in with a CPI report that's below expectations in December, that to me should give this market reason to rally. But but you never know for sure. NASDAQ 100, there you go, gap down, rally back, but this one you can see this hollow candle is red. If we go back over to the S&P and go back to that daily chart, this one is black outlined. See that? If you're not a candlestick fan, now you got a black outline there, but over here, you got a red outline. Of course, anytime you have a hollow candle, it means you closed above the open. Every time, any kind of hollow candle, black, red, whatever. If you have a hollow candle, you closed above the open. Generally speaking, I like hollow candles. If I look and I see a hollow candle, I immediately think bullish as opposed to a filled candle where I'm generally thinking bearish. And I'm just talking about for that day. I'm not talking about for the overall market for the last year, where it's going for the next year. It's a very short-term signal. But if you're above where you opened, it means generally that's net buyers. And if you're closed below where you open, then generally net sellers. So anyway, the difference though, the reason this one's red is that the NASDAQ still finished down for the day. It was down $62. So if you have a hollow candle, but you're still down for the day from the prior close, then it's outlined in red. The S&P 500, because it actually turned positive, that hollow candle is in black because we finished up for the day. Hopefully that makes sense. IWM. So this is the one that kind of got my attention. I'm going to, you can see generally the uptrend here. Okay. So I'm going to shorten this first. And then when we look at 6 months, you may not see quite as much of an uptrend. But what I'm watching are some key support levels. And the reason why I really like this chart, when we got back down here, I think this was down to like 213 and change at this low. And then of course, if we did candle bodies, we'd come in around 215, meaning that we hadn't had an open or a close below 215. Yesterday, we opened at 214.50. So I kind of felt like yesterday was make or break on this move to the downside. Either we're going to have a recovery and get back up above that 215 level, or this is about to go south, possibly even in a bigger way. And yet we got down there, we opened. Let me show you that 5-day, 10-minute chart. But there was at right around noon. See that double bottom right there? And I think the second we may have gone just a tad lower, right about the same. The low there is 214.07, 213.97, and then right here, 214.05. So it didn't quite go below. But both of these were below that 215 candle body support that I showed you. And then the other thing that I looked at, which gave me a little bit more reason to consider a leveraged ETF, was the fact that we were down. Essentially, we were as close to the 50-day moving average yesterday as we've been throughout this rise off of the, or excuse me, I think I said 50-day, 50-week. Since this began back in the month of October of 2023, this uptrend, once we broke above the 50-week moving average, we never went back and tested it. Here, we got as low as 195.45, which was close, but not there. Yesterday, we got down to 213.97, and that 50-week moving average is 212.13. I mean, so I not only had a double bottom in and had that support that I was looking at around 214, 215, but then also had the 50-week moving average coming up at 212. So I kind of felt like at 214 or a little above 214, that's kind of like splitting hairs, waiting for another $2. It was less than 1% away from support, where at 214, we were $26, which is probably about 12% away from resistance. I mean, you start talking 12 to 1 reward to risk, that's when it starts to get, a little bit more exciting. Doesn't mean it's going to work, but if it does work, it could be a great reward versus the small amount of risk that you take. Now, when I say small amount of risk, when you've got inflation news coming out pre-market, you don't know where the market's going to open. So that, for me, was the biggest risk. I mean, who's to say tomorrow that we don't have a CPI number comes in 0.4 or 0.5, blows the number out of the water, and IWM might gap down $10. I mean, that could be a 5% drop at the open, which would be a 15% drop on the TNA. So got to consider that. I mean, when I talked to members late yesterday in the daily market report, that's what I pointed out. It's like you got to have a really aggressive mindset, to take on the IWM or especially the TNA, going into a couple big inflation reports. But again, I'm kind of basing that somewhat on an educated theory that I don't think Wall Street's worried about inflation based on the way everything's been trading, all the intermarket relationships and so forth. So that's why, for me anyway, I thought it was worth the risk, even though the risk was considerable. And we'll see. Tomorrow's still the same. I don't know what I'm going to do with the TNA right now. I have it. I might sell it. If we get a pop, bigger pop later in the day, I might take some profits and, maybe just wait and see what happens in the morning, go back to the IWM. And if we do gap down, think about maybe another switch over to the TNA. I'll make that decision later in the day. I have no idea right now what I'm going to do. I'm going to see how things trade. I'm going to look at the under the surface signals and try and make a call based on that. Transports also had a nice reversal. You can see a lot of tails down around this 15,750 level. This is also the low that we had back in early October, right around that 15,750 level, actually a little bit below there. We've gone a little bit below here over the past few weeks, but we keep holding it. So I think we're in a very narrow range right now on the transports between the lows around 15,750 or just below, and then the high at 16,250, because keep in mind that declining 20-day moving average now is at 16,183. So if we go up and close above 16,250, we're not only breaking out of this 3-week range that we've been in, but we're also taking out that 20-day moving average. Now, if I'm just looking at this technically and I don't consider anything else in the market, and I'm just looking at this chart, this is a bear flag, which normally breaks to the downside. We, straight down, pretty good volume, and then sideways action. Normally, you are going to get a break to the downside. And, what I've said about the first quarter, I think the majority of the choppiness that we see in the market or even selling, I believe is going to take place in the first quarter as we go through this uncertain period of what the Fed's going to do. Are they going to cut rates going forward? Are they not? What's the inflation picture looking like? Because we know the media is all over this. We know the volatility index is sitting up near 20. I mean, if news comes in bad, things could accelerate to the downside. I don't want to waffle, but I mean, in the short term market's really hard to call. And especially when a lot of the folks out and about are worried about inflation, and we got 2 big inflation reports coming up. Depending on how these come in, could play a big role in which way we go. I don't know what the report's going to do. I don't know how they're coming out. I mean, I'll see how they come out, and then I'll see how the market reacts to them. And then, kind of take a look at it from there. Do want to mention for anybody who is new to Earnings Beats, if you go over to our website, earningsbeats.com, you can start a no-cost trial. That's a 30-day trial, get everything we offer, and just make up your mind over the next 30 days if you want to be a longer-term member. We do offer great rates on annual membership that can save you a ton of money from monthly membership. So if you get toward the end of your trial and you like it, I would highly recommend the annual, because you will save a lot of money taking on an annual. Also, if you scroll down, you will see an area down here where you can put in your name, email address, and subscribe to our free newsletter, Earnings Beats Digest. So on Monday, I gave what I think is the best looking Dow stock for 2025. And I was doing it from a standpoint of a bit longer term investor, not so much a short term trader. So I was looking at the long term charts. I was looking at weekly and monthly charts to kind of make this decision. But anyway, if you want to get this, and by the way, tomorrow I'm going to do another one, and I'm going to look at a company that I think is going to have a really good earnings report coming up based on relative strength, the way it's been trading on its absolute price chart, also the way it's been trading relative to its peers and to the S&P 500. So if you want to get that, you also, as part of the EB Digest, will get that. But let me show you go back over here. I'm going to show you the chart that I gave for my top Dow stock. I picked Merck. And I think the first quarter, again, you look at this chart and you're like, whoa, 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 whoa. This would not be my pick if I'm talking about trading for the next week or 2 weeks. I'd need to see a breakout. I need to see some kind of confirmation here. Right now, we're in a downtrend, and in my opinion, some kind of a flag, which very easily could break and go further to the downside. I'm talking about the entire year. And the reason I bring this one up, if we look at the, I think I probably looked at it on a monthly chart. Yeah. I mean, if you look at it on a monthly chart, don't you see a little bit better looking chart than on that daily 1 year? I mean, here we can see we've had plenty of these pullbacks, just like the one we've had in 2024. I mean, we were up over $130. Now you can get the stock at 100. That's $30 off, which is, probably 15, 16%, something like that, off of the previous high. The company, I think, has got a yield of 360, 370, something like that. So you pay a good dividend. You're getting it on a pullback. I mean, if it gets back within a year or two of that 130, well, if you did it in a year from now, you'd make 30% in capital appreciation. Plus, you'd be collecting that 3%, 3.5% annual dividend. So your total return could be over 33% just by doing what we've done in past history, which is go back up to the prior high. But if you look at this, every time the monthly PPO gets close to zero, which is where we're heading right now, and we get down to the 50-month moving average, which is where we're headed now, and when we've had the monthly RSI drop below 50, which is where we are now, I mean, you look at this period right here, maybe this period right here, but definitely this one, these two, this right in here, got a drop in the beginning of 2020 with the pandemic, 2021. I mean, all of these periods are kind of like that. And every one of them turned out to be great buys for the next year or two. So, I'm kind of looking at it from a bigger long-term perspective. And that's where I come up with maybe Merck being one of the better candidates, because it's already had that pullback. Even if the market, it weakens because of inflation, you're in an area of the market in healthcare where price is generally going to go up, at least to the tune of inflation. So I think you're a little bit protected there. And then if the market just simply rebounds and inflation is not a problem, I mean, Merck over the years grows its earnings, grows its dividend, and I think this pullback is just an opportunity. Again, that's more of a longer term call. So if we do break down the short term, don't send me any hate mail. I'm kidding. We don't really get any hate mail, but that's one I just happen to like in the longer term. So make sure if you're over at earningsbeats.com, you sign up for that free newsletter. I think you'll enjoy it. We've had tens of thousands of folks join. Why wouldn't you? I mean, it's free. You disregard it if you don't like that day's article. Disregard it. But I'm trying to use it as a platform for further education for folks that maybe don't, maybe are not in position to pay us for our paid service. A little bit of a community give back, if you will. Trying to help educate. Maybe you'll get to that point where you are ready to have more of what we offer in our paid service. And so we just do it to help everybody out. So check that out. Love to have you on board with that. Okay, so I pulled up our industry groups, and we got about a few more minutes here. So I wanted to just point out this is a 1 month. So that's about how long this market's really kind of been in this funk, maybe a little bit more than a month. But here's a 1 month chart, or 1 month chart list showing you the various industry groups and what's been doing well. So these are groups. This doesn't mean that airlines is up 9%. It means that airlines are beating the S&P by 9%. So if the S&P is down 4%, airlines would be up 5%. So it's just a relative performance versus our benchmark S&P 500, which I think is a really good benchmark to use. Anyway, you see airlines, you see exploration and production pipelines, so a couple of the energy areas, drug retailers, healthcare providers, clothing and accessories, oil equipment and services, again, back to that energy area, aerospace, biotech. So we've got a couple healthcare areas in here with biotech and and healthcare providers. Pharmaceuticals, another healthcare. Medical equipment, another healthcare. Integrated oil and gas, energy. And then we get down to internet. Internet's the first one that I consider to be a really aggressive group that has outperformed the S&P 500 over the last month. Haven't been a whole lot of them, but internet is one of them. So I thought, take a look at this group. And you can see yesterday, put a nice hammer in right on the 20-day moving average. We do have tops here. So it looks to me like a move up with a cup and a handle. So I would expect this group to be really strong if we get another tame inflation report tomorrow. So stocks like Meta, Google, Netflix has really been beaten up. They've got earnings coming up. I wouldn't be surprised to see this one's Netflix start to turn back up. We pull up Netflix, you'll see that it's gone down below the moving averages, but it made this straight up move starting at about the 775 area. We did have a little bit of a pullback in the middle part of November where we got down to about 815 or so. And then we broke out from this prior top a couple of days earlier at about 835, 840. So I think that is probably a range that I would look for. I guess anything can happen. If inflation's a big problem, then certainly we could easily go back to that 775 level. But I'm kind of watching this 815 to 835 area on Netflix. And Netflix was up a couple bucks to 842 after it reached a low yesterday. Actually, this market's open. So that's today's action. Let me get the inspector. Because yesterday, I think we got down below that 835 level. Yeah, 829 before we reversed. And so today we're at 840, simply flat with the market. Let's take a quick look at see what's going on here. I'll do it on a short-term 5-minute, 10-day chart. QQQ. Gapped up, but it has pulled back. It's up 0.4%. Spider, same thing. It's up about 0.4%. Diamond, same thing, up about a third of 1%. And then the small caps actually still holding on to a lot of their gains right now, up about 1% to 219.38. Anyway, like I said, I kind of like the small caps here, but you got to be willing to take a big risk going into tomorrow with the CPI report. So, it's always a tough call in the market. Let's see what the VIX is doing. VIX is back down below 19 into the 18. So that started off on the right foot. Instead of putting in higher highs and higher lows like we've seen for the past several days, we actually have a lower low to start today. So, baby steps to try to get this thing reversed and moving back to the upside. All right, let's see. Oh, I wanted to look at a couple more indices. I know we're just past 9:30, but let me pull up. I want to look at the semiconductors. Got a big head fake there a week ago. You can see this move up above 21.5, taking out the highs that we saw from back in June. I thought that was a really important move. And then I said, well, hey, have no fear. If we fail to hold the breakout, there's always the 20-day moving average. Didn't hold that one either. We did hold on to recent lows, though. Or at least so far. We reversed yesterday, printed that reversing candle. And now today, the group is up over 1%, gapping back up to the moving averages. We'll see if we can get through. But I really think going forward, some of the recent lows that we've seen on the major indices, on semiconductors like here, we got down to 18.5, but we haven't closed below about 18.9 or 18.8. So that area, 18.5 up to about 18.8, is an area that I would watch really closely on the semis, because if we go down and we close at a 3-month low on semiconductors and the VIX is rising, market's breaking down below some key support levels, VIX is up in the 20s, that's the recipe of impulsive selling to the downside. Listen, I can be as bullish as I want, and I'm bullish later in 2025. Right now, I'm just kind of watching things and expecting some turbulence and some back and forth whipsaw action. But if we get these breakdowns, impulsive selling, even during a secular bull market, you can have these periods of impulsive selling. We saw it back in early August. The IWM lost 15% in 2 days. And that was because of not so much inflation fears. It was from the fact that the Fed did not lower rates at that meeting and didn't even talk that like they were going to raise them, or excuse me, cut them at the next meeting. And that was the reaction we got. So if we get a bad CPI report, anything is on the table in the short term. And then once you trigger selling and impulsive selling, support levels, all that stuff goes out the window. An impulsive burst of selling pays no attention to normal technical analysis. It's an irrational market when you get VIX levels that go up into the mid 20s or into the upper 20s or into the 30s. Nothing else matters at that point. So anyhow, I wanted to show you the semiconductors and then also the software, because these two, along with the internet, pretty big. You can see software gapping up off of this reversing candle yesterday, a little bit of a hammer, and it occurred right into this gap support area, although there are a number of other support levels down below. I just think maybe at a minimum, if the CPI isn't bad tomorrow, that maybe this will lead to at least a 20-day test. And then we got other issues we got to watch to see if we can get through, because a downtrend normally is just a series of failures at the 20-day moving average. So we're very oversold here in the near term. We got a reversing candle, got some positive inflation news out today, getting a nice little reversal. Tomorrow, if we get something that's okay with CPI, I could see maybe 20-day test coming in some of these areas. In some areas, we may just be sideways consolidating. We may start to move back up toward some recent highs. But anyway, that's the way I see it right now. Again, good news today on the PPI front, but we got CPI tomorrow. So keep the crash helmet on, buckle up, and be ready for another day of, pounding heart going into that 8:30 announcement. We'll see which way we go after that. Anyhow, everybody have a great rest of your day. And again, like our video, subscribe to our channel. That will really help us in our community. So please do that for us. And we'll be back. I'll be back later in the week over at Stock Charts for the next video. We do a weekly market recap video at the end of the week right here on our Earnings Beats channel. So make sure you're subscribed. And then we'll be back next Tuesday for another Trading Places Live. Have a great day, everybody. Happy trading.